Good afternoon, everybody. Thank you for being part of our information session. We heard everybody very clearly, and one of the interesting observations we've made is that the state and estate settlements, and how do estates and executors, and how do we translate information between one generation and another, and how do we administer all this, was a very topical issue, and there was more information required. So today, I'll introduce Paula later, but we're very pleased to have a very good speaker on this issue and with great expertise. So before we start, I just want to do a couple of one maintenance item. So Paula Lester, who I'll introduce later, we're going to hold off our questions that you have until after the presentation. Anybody at home and Zoom can send questions to us via the Zoom chat room, which you have there, or by texting them to 905-376-6500. And in the office here, anybody here can do the same. And after Paula wraps up, we've elected Kent, because he's been one who hasn't been in the office much lately. So we've elected him to be the one staying after hours to answer any questions while we all leave and have our coffee. So thank you for coming. This is actually a very important session. Anybody who knows me knows that we speak about the will as the family shareholders agreement. It's a very critical document that needs to be thought through very carefully and changed on a very regular basis if necessary. One of the comments I always make as a side comment is the reason why it's so important is because the will is written in legalese. But it's amazing when people read wills, and I've noticed this from experience, is that people interpret the language very differently. You know, you may have a number of children all born at different times, and they all interpret information of what mom and dad said in a different fashion. And the joke I always say is, I don't have your forwarding phone number. We can't call you and say, what did you mean by that? So we're so pleased here to have Paula Lester because unfortunately the incidence of estate litigation is rising. Values are becoming more material and people are interpreting it, and there's some strong emotions associated with this. And therefore today we're going to have Paula speak about estate administration and some of the issues that you see. And we have to limit this to 45 minutes. It could be a 4.5-hour conversation. So as a formal introduction, Paula, thank you again for coming, and we really appreciate it. We borrowed Paula from Raymond James. Raymond James is a custodian of your monies. So Paula is a senior trust officer at Raymond James. She is responsible for providing comprehensive estate incapacity and trust planning services to Ontario-based clients of Raymond James Trust. Paula has worked in the trust industry since 2017, prior to which she practiced as a family and estate litigator. God bless you. Paula is passionate, and she is about using trust and estate services to protect clients and their families and to avoid the unfortunate situations she witnessed as an estate litigator. Paula is a graduate of the Juris Doctor program at Queen's. Having graduated on the Dean's Honors List, she is also a Bachelor of Arts honors degree with a major in psychology and a minor in English and law, and earning the University Medal of highest academic standing upon graduation from Carleton University. Yay. Paula also has her Trust and Estate Planning, or TEP, designation. Outside the practice, Paula likes an active life, running, ultimate frisbee, enjoys giving back to community through coaching and involvement in charitable work. Paula, thank you, and we look forward to your comments. Thank you.
Thank you. That was a wonderful introduction. And I do echo all of your comments about estate planning, about estate litigation being on the rise. We'll touch on a bunch of that during the presentation. And as you mentioned, we only have 45 minutes, but I hope to give you a good taste and flavor of the things that you should be thinking about now, and ultimately your executors will be thinking about later. And I'm just gonna, I guess I'm supposed to have to share the screen first, right? Yeah. Make sure I'm doing this properly. Excellent. All right. There we go. That was my waiting screen. Oh, I was like, it's a very lovely screen. All right. So as a quick disclaimer, nothing in this presentation should be construed as legal or tax advice. As I'll probably reiterate a number of times throughout the presentation, I always strongly recommend that you work with legal and tax professionals when organizing your own estate plan, so that they can address your specific situation. So I've divided the presentation into two parts. Am I okay?
I'm just going to move this.
Yeah, just move that. So we just, yeah, thank you.
Yes, so I've divided the presentation into two parts. One speaking about the actual role of the executor. So regardless of who you've named as your executor at the moment, or if you are an executor attending the presentation, you're going to want to know what are the duties of the executor, what does the executor have to do, and what does the executor have to know when administering the estate. And then the second part is building off of that is how can you plan ahead? How can you help your executor now? What can you do at this time in order to sort of ease their burden? So speaking about the executor. So this is a snapshot of what the executor has to do. And I'm not going to go through all of these. It's really just to give you a sense visually that the executor's role is vast. There's a large number of tasks. We say approximately 200 tasks, and it takes approximately 1.5 to 2 years to administer your average estate. So we're talking about an estate with, maybe residential real estate and investments. We're not talking about an estate that has active business, multiple corporations, assets in different jurisdictions. Those can take much longer. And certainly if there are ever any challenges or hiccups with the estate administration, I mean, I have seen estates that have been going on for 10 years. So this is just a snapshot. The first thing your executor is going to want to do, and that's the first bullet point, is they're going to want to read and interpret the will. And to Richard's point, the more clear your will can be and the more clear the circumstances around drafting your will and any other documents are, the easier of a time your executor is going to have carrying out the wishes in your will. The next thing that they're going to do, or rather, switching to the slide here, their role then I divided into 4 main categories. One is the part that we sort of think about to begin with. They deal with the assets of your estate. So your executor is responsible for wrapping up your financial life, liquidating things that need to be liquidated. So selling real estate, liquidating stock, if that's what needs to be done. And ultimately transferring your estate over to the beneficiaries. But it goes much more in depth than what we generally tend to think of when we think about that. Another really important aspect for the executor is estate accounting. And that means keeping a full record of everything that gets done in the estate. And so we'll go into what that means. Taxes, a very large part of death. It's not just while you're alive, it's also after you die. And there are very specific tax rules around death. So it's very important that your executor is aware and uses an accountant. And then dealing with beneficiaries, I've included on there because that is probably what breaks most executors. It's dealing with other beneficiaries because it's a very taxing role to be in the middle, and the person responsible for what is ultimately other individuals' money. So this is what the estate actually looks like. So we have, your executor is going to want to figure out what are all of your assets and what are all of your liabilities. That's more of a snapshot on the date of death. And the executor is going to have, their first task is to figure out what all of those are and what is the value of all of those. You cannot deal with assets if you don't know what they are. And some of these assets are very time sensitive in terms of how your executor has to deal with them. So as an example, if you have an actual operating business, your executor is responsible for dealing with your share in the business, whether it's through a partnership, whether it's through shares that you own in a corporation, or whether it's a personally held enterprise. Often, if there's no good succession plan in place, the more time that ticks on, the less the business is worth because clients start to move elsewhere. And so you may have a value of a business, let's call it $5 million on the date of death, but by the time the executor can actually transfer that business to someone else, sell it off, it may be worth $1 million. That's a huge loss to the estate. So each of these assets can hold their own unique challenges. And in part 2, we'll talk about how can you best, set up your executor for success. One thing with most assets or many assets is that your executor will not be able to sell them or deal with them fulsomely right away. So most of you have probably heard about what is probate. Nods around the table, perfect. Maybe some nods at home. So basically, although an executor is named in the will as your executor, any individual dealing with them, so Richard has the investments here, the executor comes and says, here's the will, now release the $3 million investment account to me. Richard's going to say, well, I need proof and I need protection, because if I release these monies to you and then there's a challenge to that will, or it turns out there's a new will, there's another executor, I can be liable for those $3 million. Similarly, real estate can't be transferred. The land registry office won't allow an executor to transfer real estate until they have that proof of the validity of their appointment as executor. So in order to get that proof, they have to apply to the court for what we commonly call probate. And that process can take a while. So in order to apply for probate, you actually have to have a full listing of the assets and liabilities on death. And there may be some other steps involved. Generally speaking, collecting all that information takes about 3 to 6 months before you can submit the application. And depending on the courts, it can take anywhere from 2 to 6 months to hear back. So it can be a long time. Like I always say to beneficiaries, do not expect any payment out of the estate until at least 9 to 12 months after death, because we can't actually do anything until we have probate. Now, some assets don't need probate. The main one that an executor can deal with without probate is closely held shares or private shares. So if you have a holding company or an active company with shares, your executor can actually go on to deal with them without requiring probate. But other assets do need probate. Okay. And then, so those are the assets that they deal with, but then they also deal with your transactional life. So did you have sources of income? They have to call and cancel all of those sources of income. Did you have, ongoing expenses? Some expenses need to be canceled right away. Others need to be continued. So for example, if you have a house, you don't want to, cancel hydro right away because you want to be able to turn on the lights until the house is listed and sold. But you may need to change the terms of that service, or at least notify the service provider that they're supposed to be dealing with you as an executor. Some things executors can get caught up on, they're not actually aware. And one of the big ones that I always highlight, it seems small, but is the insurance on the house. So the house is no longer occupied, most likely, if you and your spouse or you have passed away and there's no one living in the house. So now the insurance on the house actually needs to be changed. If the executor does not deal with these assets properly and something happens, so let's say they didn't change the insurance on the house and there's a fire or burglary, then they are personally liable for the loss in value to the estate. And so that's something that's really, really important that executors are aware of. They are personally responsible to safeguard the estate, and that liability falls on them. If they've acted prudently, then that's okay, and something bad happens, that's okay. But sometimes there's that gray ground, and that's where a lot of conflict can come up. Another one that executors often don't do is they often don't speak to the financial advisor right away to say, liquidate the investments. You as an individual can have as high risk investments as you would like, but when you've passed away and now someone else is responsible for safeguarding that money and passing it along to your beneficiaries, they need to make sure that the stock market doesn't crash and it goes down 25%. So generally we liquidate and we hold it in whether it's money market or something that produces a little bit of interest but no volatility, unless all of the beneficiaries are adult and in agreement to keep it invested. So that's that piece. And I could go on about that part for a very long time. There's so much involved in dealing with the different assets and liabilities of the estate, but we just don't have the time. So the next part is estate accounting. So this is something that executors often will not do because they're not aware that they have to. But one of the responsibilities of the executor is to make sure that they keep a full report. First of that starting snapshot. What is the estate made up of? And what is the value of everything? And one thing I haven't mentioned is that some assets need to be appraised to be valued. So obviously what's in the bank account, what's in the investment account, the date of death, that's easy to find out, but real estate, businesses, and so on may need to actually be appraised. So they need that snapshot on the date of death. What are the assets and what are the liabilities? So you can see there the initial assets and liability statement. And then they need to keep a record of transactions. And that's all the money that's collected in, all the debts that are paid out. If they're paying themselves any money, they need to keep a track of that. but they also need to keep track of any decisions that they make. So if they have decided, yes, I'm going to accept this offer for purchase of the house, why did you accept that offer of purchase? Why not another one? Why didn't you hold out longer? Was there a bidding war? What was the circumstances for making your decision? And the reason for keeping track of that is because executors can be challenged on any one of their decisions. So if a beneficiary later says, well, this house down the street that was the exact same sold for $50,000 more, why did the executor make the choice that they made? Because if they acted rashly or they didn't have good reasoning behind their decisions, then again, they can be held liable for potential loss to the estate. I should mention, obviously, one of the things that you'll think about is who are the beneficiaries, right? If you're the sole beneficiary and you're the executor of the estate, a lot of these risks are lessened. Although you do have to think that as an executor, you also want to keep track of this for tax purposes and potentially for probate purposes and potentially for dealing with creditors. So something to keep in mind. And then you should be providing or keeping regular updates of that snapshot. So as you deal with the estate, so maybe the house then gets sold and cash is added to the estate bank account, which I'll speak about in a moment. You then want to then create another snapshot 6 months later. We now no longer have real estate, but we have X amount in the bank. And of course, you want to keep track of as monies are paid out to beneficiaries, so distributed, you want to keep track of that as well. All right, so estate accounting. So this is just a list of what the each estate account statement should include. Assets of the date of death, everything that comes in, everything that goes out. All assets that have not been realized means that sometimes an estate might have what we call a contingent interest. So maybe you were waiting for money to be received. Maybe the individual passed away while the sale of a business was going on, or while they were settling a claim. I've had clients who pass away in the middle of, a divorce, and so that's not fully settled. So then their executor is responsible for finalizing and settling that. So those things are potential assets, but not assets that we don't really understand exactly what they are. And as an executor, you have to keep track of them. Sometimes there's claims that you might make, so someone owes you money. Sometimes you can't actually get that money paid. As an executor, you have to make a decision. Is it worth going after this person, going to court, trying to get the money back from this person who owed the deceased money, or should I just write it off? And at the bottom, there is something saying capital and income receipts must be recorded separately. So this is unique. Estates and trusts divide up income or what we consider income into two things, capital and income. So capital is the initial amount that comes into an estate. And like I said, that initial amount, it may actually grow, right? A house might be worth 600,000 on the date of death. Maybe it's worth 800,000 when it's actually sold. That's still considered capital because it's still the house that has grown in value. But other things are considered income. So let's say they're, the interest that's being earned off of investments that are invested in GICs or money market or whatever it is. That interest is considered income. It's important sometimes to keep track of what's capital and what's income if the estate then goes on to make distributions into trust, because trusts have capital beneficiaries and income beneficiaries. It's a very complex area of the law. My recommendation for executors when they're dealing with estate accounting is to obtain professional advice. So to obtain professional advice, you can, accountants, some of them specialize in this area, so they can help you through it, but estate accounting is not the same thing as accounting for tax purposes. Now that I've thoroughly confused everyone. So the other thing that in order to keep a good record of accounts that an executor should do is they should open up an estate bank account. So I've had a few clients that come to me and they say, well, mom passed away, but I had her log in for a bank account. So I was paying her bills out of her bank account and so on. Again, if you're the sole beneficiary and it's kind of okay to, I say it's never actually okay, but you might be okay and get away with that. But what you actually should do is stop dealing with mom's account, open up a new account at a bank, any bank, and in the name of the estate of mom, whatever mom's name is. And then what you want to do is, as you can collect in money, so as the bank will release money to you, as you can get, investment money released to you, as you sell off assets and bring in money, you deposit it into the estate bank account. That becomes your record. All money comes into it, all debts and everything are paid out of it. It's a very good way to keep your record separate. I've seen too many executors who will commingle assets, and that becomes dangerous because you may actually put your own assets at risk. Like, let's say you did use 5,000 of your own money to pay off some debts, and then you want to owe yourself back. If you don't keep very careful records, again, that can be challenged. Beneficiaries can come after you for that. And ultimately you can lose that $5,000 because you're not proving that that was your money. This keeps things quite separate. All right. And then dealing with beneficiaries. So we've talked about what the executor has to do in terms of they have to figure out what all the assets and liabilities are, probably apply for probate to be able to deal with them properly. And throughout this time, they have to keep a good accounting record of accounts of everything that they're doing. But during this time, they're also dealing with the beneficiaries. And ultimately, at the end of the day, the goal is to distribute the estate to the beneficiaries. And as I mentioned before, this is where we see a lot of the issues come to light. So even if an executor is doing everything properly, it can be very, very easy for beneficiaries to perceive that they're not. And the reason why is because the role of the executor is very clouded. We don't know what's involved in administering estates. And I can't tell you the number of people who think an estate should be wrapped up within 3 months. So beneficiaries sit back and they say, well, when does my money come? Why is this taking so long? Well, is the executor doing their job properly? And of course, they start to question things. They start to question, well, what was in the estate? Well, what are you doing with this asset in the estate? Well, what steps are you taking? Well, who are you dealing with as a professional? They ask all these questions. So the best thing for the executor, to do is to get ahead of it. Start from the outset. If you are not the only beneficiary, right from the get-go, you want to write what we do as a trust company is we write an initial letter that basically outlines, it says, this is, if we know what the estate is right at the outside, we can say, this is what we know is in the estate. This is what we don't yet know. This is what is in the will. This is what your entitlement is. Because not all beneficiaries have the same entitlement. Some just get a specific amount and they don't really care about anything else. They just want to get their specific amount. Some get residue, meaning a portion of what is left over in the estate. So maybe half of the residue goes to this person, half goes to another. They actually really care about the size of the estate because the bigger the estate, the more they get. They want to know what their entitlement is. And then it's nice for the letter to include expectations or manage expectations. So here's the expected timeline. That's a really nice way to start off the relationship, and put it in writing, even if it's your siblings, because you can have the talk with your siblings and then you can hand them the letter, but at least then 6 months down the road, when everyone is forgetting what was actually spoken about in that conversation, everyone can go back to that letter. So that's a starting point. And then it's good to keep updating these individuals. That record of accounts that I mentioned, residual beneficiaries in particular are entitled to routine accounting. What's in the estate and what's being done with the estate. It's also really good to, even where it's not required, get the approval of all of the beneficiaries, particularly if they're adults. So say, this is what we're planning on doing with the cottage. This is what we're planning on doing with this property. This is what was recommended by by our accountant to deal with the holdco, because holdcos have their own special issues with taxes. Let everyone know. Just make sure everyone's sort of on the same page as you go along. Sometimes it's not easy, and it doesn't matter if you do everything right. Sometimes the relationship between the executor and the beneficiaries is setting the executor up for failure. If you have a sibling that you never got along with as a child, and now you're the executor and they're a beneficiary, that is not going to end well. I have had clients say to me, oh, this will bring them closer. And I try my darndest to tell them all my stories from litigation. I have countless stories of siblings that will never speak to each other again. Never, ever, ever. And I have a lot of clients actually who end up appointing the trust company as executor because they say, I was executor and I don't speak to any of my siblings. And it's heartbreaking. And it's not just siblings, right? It's also their spouses. That's a big factor. And sometimes they're not even family members. Sometimes the beneficiaries are a number of different friends who never knew each other, everyone with their unique personalities. So keep that in mind when thinking about who your executor is, and make sure that your executor is fully aware and willing to take that on, and that aspect's not going to be an issue, because that in and of itself is the most taxing part, I find, for a lot of executors. Okay, so ultimately the executor wants to make a distribution. Normally you don't make just one distribution from the estate. So normally what happens is you, as an executor, you apply for probate, you obtain probate, you now can you're in a position where you can actually deal with the assets, you can sell the property, you can liquidate the investments and so on. But what you want to do is, first of all, work in order. So the first beneficiary that gets a gift out of the will are those who get specific gifts. So if the car is gifted to someone, or the house is gifted to someone, or a specific investment portfolio is gifted to someone, they get that gift. Then it's those who receive specific cash amounts. They get their gifts. And then it's the residual beneficiaries, the ones who it's not specified, they just get parts of whatever's left over. You want to make sure before making a distribution that you still are in a position to pay all the debts of the estate. And so generally speaking, you want to either wait for the first notice of assessment for the terminal tax return. So that's the tax return that's filed after a person passes away, and it's a special type of tax return, or get advice from the accountant as to what the estimated taxes are, and then withhold a healthy buffer on top of that. Because if you distribute too much of the estate before you've paid all the debts and taxes, and it turns out they're more than you thought, and you're not able to get the beneficiaries to pay the money back, again, as an executor, you are personally liable for those assets, for those amounts. So that can also become an issue. I know for a lot of executors, and even as a trust company, we deal with it all the time, where people say, well, I want my money, I want my money, I want my money. It is okay. It is more than okay for you as an executor to say, I understand, but I've been advised, blame it on the professionals, but I've been advised by the lawyer, the accountant, not to make a distribution until X. Hold that back, because you need to protect yourself at the end of the day. They will get their money. It is coming. It's just, you want to make sure that you're doing it. Tick, tick, tick. Now's a good time to sort of say a note on taxes and how they work on debt. So the day that you pass away, you are deemed to have disposed of all of your assets. So that means you're deemed to have sold all your real estate, sold all your stocks, liquidated all of your registered accounts. And whatever the tax burden is that you would have if you actually did that on that day is the tax burden that your estate faces. The caveat is that if you leave your estate to a spouse, common law or married, those assets can roll over to them tax deferred. So generally speaking, with spouses, we don't see a big tax burden on the first death. It's generally when the second spouse has died. If you think about it, there's a few things that really push you into a high tax bracket. So clients with large RRSPs or RIFs, that all gets pulled into income in the year of death. That's a very large tax burden for a lot of individuals. If you have a holding company, you are deemed to have disposed of all of those shares, and generally the worth of your holding company is the worth of the investments in it, and the book value, the starting value, just a cost base, that's what I was looking for, is zero. So the whole value is considered capital gains. So those things can push you into, again, high tax brackets. Holding companies have their own specific tax issues, because not only is there a gain on death, but then to withdraw the money from the corporation causes taxes. So if the corporation has to sell the portfolio within it, there's going to be tax at the corporate level. And then as you withdraw it, if it's taxable as dividends, there's going to be tax on that. Accountants have a lot of techniques in order to reduce those taxes. But if your executor, if your estate has a holding company, your executor should get accounting advice very quickly and deal with it quickly, because some of those have strict timelines. Anyway, so that's my piece on making distributions. So ultimately what you'll do is you'll make a large distribution, probably around the 9 month to 1 year mark. And then you might make another smaller distribution, probably closer to the 1.5 to 2 year mark. There should be a small amount held back, because at the end of the day, once the estate is pretty much wound up, as an executor, to protect yourself from further audits and reassessments from CRA, you'll want to apply for a final tax clearance certificate. So you do the terminal tax return, so that's the tax return on death. You'll probably do at least one estate tax return, maybe 2, and maybe more if the estate goes on forever. And then once you've done the final tax, you'll apply for a notice of assessment, you receive that, then you apply for a clearance certificate. That takes about 12 months to receive from the date you've applied for it. So that last piece of the estate is going to be held on to for a good while, but it shouldn't be a huge amount of money at that point. All right, so I'm just going to press. So the last piece here is planning ahead. How can you plan ahead? Well, first of all, take note of your estate. Some estates are relatively simple. Even simple estates can be taxing for an executor. And I've certainly had executors ask us to settle simple estates, because for them, it's just a novel territory and they don't want to do anything wrong. But there's a lot of factors that will complicate estates. So one of the factors is, do you have a blended family? A lot of individuals I speak to who are have a second marriage or with a second partner, they say, well, I want to leave everything to my kids from my first marriage. And that's fine, my partner's fine. But as we delve into it, the truth is that often you actually have obligations towards your new spouse, common law or married. Married spouses have both support obligations and also possible property equalization claims on death. Common law spouses, it's generally the support obligations. And so you don't want to leave everything to your children from your first marriage, only to then have your common law partner or your married partner make a claim against your estate when you pass away. That's going to cause issues. The other thing with blended families is there can be just unique dynamic issues between the families. So if you're leaving to your children, also stepchildren, and they don't like each other, whatever the case might be, we want to address those from the get-go. And again, make sure everything's in place so that it transfers as smoothly as possible. So whether that's dealing with your support obligations, making sure you have a marriage contract in place, whatever the case might be, we want to make sure we're dealing with that. Operating businesses, as I mentioned, those are very difficult for an executor to deal with if the executor is unprepared. So making sure you have a succession plan in place and making sure your executor knows what the succession plan is. So do you have a buy-sell agreement? Do you have a shareholders agreement? Do you have partners that would buy right away that your executor should approach? Have you done a business valuation recently? All of these types of things are things that you can do in order to better prepare your executor. And both with operating businesses and with holding companies, because they have unique tax issues, there's some things that you might do, like corporate health insurance, to help with some of those unique tax issues. Holding companies, as I mentioned, generally speaking, it's the unique tax issues that we're dealing with. Although I recently read in a will that was unfortunately poorly drafted, that actually instead of gifting the estate to a number of individuals, actually gifted the shares to a number of individuals. And that's a big concern, because what the person has done is they've named, I think it was more than 9 individuals to actually jointly own shares in a holding company. So we're going to hopefully get that will fixed. So that's something to keep in mind. Foreign assets and other cross-border issues. So the second you have something cross-border, so if you have an asset in another jurisdiction, so I don't just mean outside of Canada, but outside of Ontario, especially being in Ottawa, a lot of individuals may have cottages on the Quebec side. If you do, it's strongly recommended that you actually have a will in Quebec to deal with those assets, because the law is different. One of the big things for these cottages is spouses will often have all their assets joint or each other as beneficiaries. So when one spouse passes, the other spouse just automatically gets everything in Ontario. Quebec doesn't have that. Quebec does not have joint with right of survivorship. Quebec, you die, your estate owns half that cottage. So in order to make it easy to transfer that to your spouse, having a Quebec will can be really handy. In other jurisdictions, other countries have their own laws around these assets. And so we want to deal with legal advice, a lawyer in that jurisdiction, to figure out, do we need to do unique planning in that jurisdiction? Sometimes the Ontario will is okay. It will do the job just fine. Sometimes we have to go a little more in depth. And then other cross-border issues. One thing, does your executor reside outside of Ontario? If your executor resides outside of Ontario, but in Canada, they can still administer the estate, but they're probably going to have to post an estate bond. That's an amount that you actually have to pay into court to guarantee that if something goes wrong with the estate, there's money there to pay out the victims, whether that's CRA, whether that's beneficiaries, whomever. And the reason why is because the Ontario court doesn't have the reach to go over to Manitoba or to BC to basically come and find you and get that money back. There are ways to dispense with that bond, but they're not necessarily easy to do. If your executor is outside of Canada, revise your will, because having an executor outside of Canada has very serious consequences. First of all, your estate will become a non-resident, and Canadian estates have very preferential tax treatment. Having a non-resident estate it just causes a tax nightmare. But it also causes a nightmare for your executor trying to deal with assets here, because investment advisors, banks, even lawyers and real estate agents all have restrictions on dealing with foreign individuals. So we have a lot of clients with children in the US, and often I do find that they're appointed as the executor until we note this and point it out, and then they change their executor, whether it's someone else or whether it's a professional executor. So those are costs. And the other time, so anytime you have beneficiaries in another jurisdiction, assets in another jurisdiction, or you yourself are a dual citizen, that can add some complication that needs to be addressed. Charitable beneficiaries, charities are wonderful. They do wonderful work. Leaving money to charity in your estate can be a wonderful way to leave a legacy, and also has very good tax consequences. It can really minimize or even erase your taxes on death, depending on how much you give. But charities are also sticklers, and they want to make sure everything's done by the book. They can be difficult to deal with as an executor. But the other piece is not all charities can accept the bequests you make to them. So I have a lot of people who say, oh, I'm going to leave this artwork to the National Art Gallery. Do you know how much stuff the National Art Gallery gets donated every year and they turn down? So make sure the charity can receive that. Some charities can't receive large gifts. If you have a small local charity and you're donating to them $1 million out of your estate, they may have to turn that down because they don't have the infrastructure to deal with those significant sums. Plus, they have a disbursement quota and they may not be ready to use those sums of money. So that's another thing to think about when in your estate plan. Disabled and vulnerable beneficiaries. So vulnerable, I mean those who are maybe not good with money, maybe they're children and they can't inherit outright. Maybe it's a spouse who's never managed the finances and needs some protection. And obviously beneficiaries with disabilities. For them, often in your estate plan, instead of giving them money outright, you may want to use trusts. And your executor, unless you've named someone else, then becomes the trustee of those trusts. So that can add some complication to your estate. And you want to make sure you understand what these trusts are and how will they be managed. What is the task I'm actually asking of my executor and my trustee. And then conflict. I mentioned that underlies so much of the estate litigation. We see it's one person is mad at someone else, whether it's they're mad at the mom who's passed away for not giving them more or not loving them more. They always love this other sibling more, or they're mad at the executor for whatever reason. So the more we can address these proactively, the better of a legacy and a job you'll leave for your executor. And not to mention, your estate plan will play out the way that you wanted and hoped that it would play out. So how do you prepare your executor? So beyond dealing with those estate complications, make sure you keep your estate documents updated. So if your will has been sitting in your drawer for 20 years, pull it out, look at it. And even if nothing has really changed, it may be worth updating it, only because the law around what different terms mean or what types of terms we should see in a will changes all the time. It used to be common practice to have a 2-3 page will, 20 years ago. And I see those wills today from lawyers who have not updated their knowledge in 20 years. If your will is shorter than 8 pages today, there's likely information missing in your will, because your will includes not only how you want to distribute your estate, but also a number of provisions to allow your executor to administer the estate properly. The other thing is understand the structure of your assets. So as I'll reiterate again in the next slide, you don't want to just deal with a will drafter when you do your estate planning. You want to deal with an estate planner. So someone who can walk you through and asks you, what are all your assets? How are they owned? What are your beneficiary designations? What are the tax implications? Understanding them means that when you do your estate plan, you're not missing things. So you're not thinking, oh, I'm going to gift the family cottage, when at the end of the day, the family cottage has to be sold to pay for the tax liability on the RRSP that went directly to another beneficiary. So those are the types of things you want to make sure you understand. Consider your choice of executor carefully. If something here has made you cringe and feel sorry for the person that you are naming as executor, consider appointing either someone else or a professional executor. I'll talk very quickly about fees on that, because that's often a sticking point. Any executor can take approximately 5% of the value of the estate as a fee. Often, if they're a primary beneficiary, they won't take a fee because it's taxable income. So they'd rather just see it as they'd rather take it as their inheritance. Sometimes they also may not take a fee because that's going to cause increased conflict amongst the other beneficiary. But considering it's a very big job with heavy liability, I mean, I am obviously pro any executor that is doing their job diligently who wants to take a reasonable fee. It's not always 5%, it can be lower depending on how much they farm out to professionals, but any executor can take a fee. Professional executors, like a trust company, will always come in lower than 5%. And generally speaking with clients, it's generally a sliding scale. So it depends on the value of your estate. And there's often a discount given for investments held with IP Private Wealth, in your case, because they are backed by Raymond James Trust Canada. So generally you're looking at a fee probably 2.5% to 3.5%, and higher net worth clients can be closer to 1% to 2%. So just something to keep in mind. And you can always name a professional joint with an individual. If you feel you want an individual involved, you're not concerned necessarily about the conflict, but you are concerned about the gravity of the role, you can have a professional and an individual. Keep and update estate information. So I believe IP Private Wealth has an integrated will memo, which is a wonderful tool where you can track all of your assets, all of your, everything about your financial life that the executor is going to want to know. It also should include things like maybe final wishes if you have pets, what's to happen to the pets, and beneficiary contact information, important contact information, the lawyer that has the will and all of that, and a digital inventory as well. So more and more our lives are online. Sometimes there's digital assets that we actually want and need to be dealt with. Those need to be planned for specifically because every digital asset and access to it is different, and the law in that area is so muddled. But keeping a record of what your accounts are, passwords, you don't have to give that to your executor right away, but let them know where to find it when they need to. And update that routinely. And then go through your other important documents. If you have a corporation, shareholders agreement, if you have a blended family, you've been through a separation, do you have support obligations? Make sure those are reviewed and addressed properly. And as I mentioned, if you have an operating business, create a business succession plan. And then I believe this is the last slide. So the other piece is don't be afraid, and make sure your executor is not afraid to obtain professional help. So as I mentioned before, a lot of clients, because they're not really aware of how complex estate planning can be, and because they don't know what they don't know, so they don't know if the lawyer is asking the right questions or not, they find themselves with lawyers who, like I said, are more will drafters. So they'll say, what do you want in the will? Okay, I'll type it in. As opposed to a estate planner, someone who sits down with you and says, What are your wishes? What's your family situation? Let's talk about, where do people live? What are your assets? How do you own them? What's the adjusted cost base? All of those questions. You're obviously going to pay more for someone who takes the time to do that, because if I spend 15 hours, well, not me, but if in private practice, if I spend 15 hours with someone, they're paying for 15 hours of my time versus if I spend 2 hours with someone. Generally speaking, your wills run about $1,000 to $2,000 for sort of the simpler wills, and they can run upwards of like $3,000 to $5,000, maybe even higher for very complex wills or estate planning. Consider a professional executor if that's something that you feel will be right for your estate. And if you are an executor, don't be afraid to ask for help. So make sure you're dealing with an accountant and a lawyer. If you want someone to do more of that role and take over your actual duties, you can use a trust company. If you, as a person writing your will, if you're worried that your executor may not seek that assistance because they're afraid of whether or not they should pay for it, which they are entitled to, but you're afraid it might cause conflict, you can actually write into the will. You can say, it's my express wish that they seek professional help of yada, yada, yada. And it doesn't bind them by any means to doing that, but it does make it clear to everyone that you are okay with that and you are okay with your estate money being spent on that, which I find is very useful, particularly when, again, there's siblings who one's doing all the work and the other one says, no, you don't need to get any help. Just give me my money. All right.
So thank you, Paul. Before we open up for questions, I just want to make a couple comments. Again, thank you. It's always good to hear from a professional what you see, and we probably should have part 2, part 3, part 4 of this. But just think about it just briefly. I know many of the people on the call here today. I mean, the baby boomers are generating this issue because there's going to be trillions of dollars of assets transferred over the next several years to the next generation. And CRA is anxiously waiting for that to happen based on tax law. And I know many of people on the call who I've worked with, there's been a lot of good work done by your professionals, but just think of your organizational chart. Think of what you probably have. You have one company, 2 companies, a building company, an operating company, a holding company, a trust, maybe 2 trusts. We have some clients that have 3, 4 family trusts. We have multiple organizations, all for the sake of creditor protection, all for the sake of tax management, which is really good and really important and served a purpose. But as Paula said, the piper needs to play the song, and that is on the last spouse to die, Revenue Canada says, I want my fair share. So a lot of these issues have been done with really good tax and business and creditor issues involved. And then it's all about finding a methodology of transferring this without creating stress or distress to the people who are benefiting from this. So that's why, as you mentioned, we've created integrated will memos. That's to help practitioners provide for the will. Why? Because most lawyers, clients walk in and they don't even know what their net worth is or what the composition of net worth is. And the lawyer's trying to draft this within the prescribed rate that you said, trying to draft the will based on the information that's provided that's not necessarily detailed. So a lot of lawyers who have received our integrated will planning memo are very appreciative because it gives them a very good scope of what's going on. And then we're also finalizing our digital document directory. We actually have it. We're just waiting for dual authentication in our portal where we can would have access to the critical documents to reduce the time being spent on estate administration. Having said all that, it's really important to understand the nuances and how important it is to understand your family dynamic, your family, the whole issues, your wishes, and how do we integrate this. And this is not a one-time discussion. This is a regular discussion for especially business owners, especially family businesses. We've been involved in all these issues and we see some things go really well and we've seen some things go not very well at all. So really important. I think we're going to have multiple sessions, but I introduce anybody to ask more questions. I really would appreciate it. So thank you. Any questions or what's going on?
Nothing in the chat right now.
Okay.
I have a question.
Yeah.
So from family experience, not my own, but other family, family allowed a professional executor, and the executor sort of skived off with all kinds of money.
Cool.
So if you're giving an executor the power to execute an estate, and you know that there's a family member who doesn't want to do the work, but wants to keep eyes on what's going on. So do you do them jointly or severally? You don't do it jointly or severally.
No.
Jointly.
Yeah.
Okay. So, and in that, but if perhaps you're in a situation where there is only a professional executor, what rights as a family member do you have to ask for all the documentation?
Good question.
So any beneficiary of the estate has the right to ask for an informal or a formal accounting. So the first thing is you would say to the executor, it's been a while, provide me an accounting of what's in the estate and what have you done, that accounting that I was talking about. If you're not happy with it, or if they're refusing to provide for it, you can actually apply to court to get a formal accounting of what's going on in the estate. And as an executor, if they haven't been forthcoming, they can pay for that court process out of their own pocket. So generally, when there's a formal accounting, the costs are covered by the estate, if that's sort of normal. But if the executor is doing something wrong, then they can pay for it out of their own pocket. And as I mentioned, they can also then be liable to pay for anything that they have done wrong that you've discovered during the process.
That's a good question, Louise, because as you know, drafting the will, executors are usually, oh yeah, I'll name Uncle John and Aunt Mary as my executors, I'm just being facetious, but where Paula has been used in our office effectively is to often be a joint executor or a trustee. So that way you have your family connection and you have your business acumen, right? So it's really important when you're choosing executors or trustees that have both an understanding of the family dynamic, especially if there's potential conflict or misunderstanding, and the business acumen to deal with the complexity of the estate, especially if there's an operating company or a holding company involved. So you can hire the right professionals to engage in what we call post-mortem strategies to reduce taxation that have to be done within a specified timeline. So and again, you have to appoint the executor that's not going to be emotionally hijacked by timeline. So this is a very important discussion, and that's why we're bringing it to the table, and that's why we're starting to ask Paula to discuss this with clients on an individual basis and to determine whether a corporate trustee or professional trustee would be of value to their circumstances. It's becoming important.
And I will say, most lawyers are going to deal with the funds properly, but there definitely have been cases where individual lawyers who are named as executors, have absconded with money. Some of them have made the news, quite big pieces of news. Trust companies are different because it's never one individual person that ever has custody of the money or is ever able to deal with the money on their own. And trust companies, so there's layers of protection within. So multiple people need to sign off on multiple things. Some things need to go to a higher board. But the other piece is, if there was a rogue employee that somehow got away with it, trust companies are bonded or required to be bonded. So there's that extra layer of protection there. I'm not saying, like, there are circumstances in which you would want to name a lawyer, particularly if you have a long-term relationship, but as someone who is a lawyer and was in private practice, even as lawyers, a lot of them don't want to do that anymore. It's not strictly legal work. It's a very unique practice in and of itself.
But there's a lot of challenges. I mean, we're trying to make sure most families that we deal with want to make sure the beneficiary is identified and we don't have unintended beneficiaries of the family's wealth. Usually that means family law. Also, we don't want external influencers into will and influencing beneficiaries that really create conflict. So that's the dynamic we're speaking of, right? That's why the communication, that's why the process. And sometimes I think the important statement is, I think you mentioned, is if you're thinking after this presentation, oh my God, what have I done to the person I appointed? You should really have the discussion and say, well, maybe we should have a different executor or a combination of executors, including possibly a corporate trustee or a professional trustee, to assist with that dynamic, because a professional is oftentimes properly used as the bad guy, right? No, my professional says I can't do that, and that usually ends the conversation quite quickly. But that's just, again, experience that we've had. So, but good question. And
Do you have a live question?
No, I was just gonna say, if there's anyone at home that is confused by the chat feature, you can also just turn on your microphone and ask us the question.
See a chat. Oh, that's Jordan. Hi, Jordan.
Paula, one question would be for some of our clients who perhaps have adult children 20 to 30 years old. No children yet. Commonly we hear, I'm young, I might be married, I don't have kids, I don't need a will.
Oh.
Can you maybe just provide some context as to things to consider? I know you had up there, don't do the Walmart do-it-yourself kit, but give some options in terms of what they should be looking at. Because I find that that's coming up.
Yeah, well, so anytime, so in my ideal world, anyone over the age of 18 has a will. Because a will, again, it's not just the assets that you have, or maybe you have a spouse or don't have a spouse, don't have kids of your own. It's that financial life. And if you don't have a will, you haven't named an executor, then no one has that de facto right to deal with your financial affairs. And that causes a nightmare for the person who's trying to deal with it. I actually have a personal story. A friend of mine passed away at 23, I think. She was young. She had no will. And her parents, they had to go ahead and apply for probate. She had just a bank account with a few thousand in it, but they have to go through this process. They're grieving for their daughter who they lost, at way too young of an age. And they're going through this process just so that they can deal with, one bank account, do a final tax return. Having a will is really the kindest thing that you can do to the people, for the people that you're leaving behind. And certainly the moment that you have a child in particular, so I wouldn't even say just are married, but have a child, you do not want to know what happens if you passed away without a will. I have individuals who, life insurance, for example, your life insurance goes to your estate. I'm worth much more dead than alive, as many young individuals are, because my life insurance is worth a lot. And if I have no will and my 3.5-year-old inherits all of this money, it just gets held by the court for him until he's 18. And then at 18, he gets all this money. So even though you may feel that you don't have a lot of wealth, you probably have more than you think when it comes to your estate. And you want to, like I said, protect those that you love.
So we encourage, please, I know questions are always hard in a forum like this, to encourage to talk to anyone at IP, any of the advisors here to speak to it, and we're always engaged in that. I'll just end off with one story about the importance of getting it done as soon as possible and don't let it go. It's in our side of our office. Someone we know went to the hospital on Monday, not feeling well, expecting to be just leaving right away and all that kind of stuff. On Sunday morning was dead. So COVID has created some very bizarre situations, and let's be candid, medical stuff has not been diagnosed, and we're hearing stories that are quite horrific. So I guess as I get older, I'm hearing more of those stories than when I used to 20 years ago. But it's just something that, again, my opening statement is, once you're gone, we don't know what you meant by that. Right. So we're trying to get this understood and try to get the team involved and try to have your professional group to work together. And please, a lot of people use us as a conduit to get to the right information, to the right sources. But before you start spending hundreds of dollars and hours, we have that integrated will memo that allows us to at least articulate the net worth and the composition and what the general objectives are, and then take that to the lawyer for proper drafting. And they really appreciate it. We include an organizational chart, a whole detailed net worth, an estimated tax liability, and a whole process of objectives. It's a good comprehensive document that I don't think we sometimes forget we do it, but when we do it. So I encourage people to talk.
You do have a question.
Yeah.
We have one question.
Yep.
So the question is an accountant a good executor with a daughter? So, the answer is sort of, it depends. Accountants certainly have more, they certainly have more knowledge around finances. Some accountants have more knowledge around estate accounting. They're still going to, they're still going to have challenges. Some of them maybe are acting as executor for a number of individuals, and so they're getting experience that way. The other So, but they're still going to have challenges. They're still going to have to deal with other professionals, and some accountants are good at it, some accountants are not. Depends. The other aspect or the other question is, how old is the accountant? Because the risk with naming any individual is that if they're your age, by the time you pass away, they will be your age, whatever that is at that time. And so they may not want to do it at that point in time, or not able to do it. So it's something to think about, and it also depends on your daughter. What is her situation like? How much time does she have to do it? What's her relationship with the accountant? So it's a very personal question for your estate plan.
Jordan?
We have a question on text.
Yep.
Okay, so I'm gonna try and read it. So if a family business doesn't have a succession plan or partnership agreement and the shares are part of the estate now, how does the company continue operating without one in place? Is the company authority now the executor?
So when your shares go to the estate, either all or the controlling share of the shares, the executor now has the power to vote themselves or whoever else on the board, and that's how they control the corporation. So, but if it's an operating company, then it's a question, well, what is the day-to-day operation? Because they're going to have to go to someone, because your executor, depending on who it is, may know nothing about the business. So at least providing them, I mean, like I said, providing an actual succession plan is best, but sometimes the executor, if they know one person to go to, they'll appoint that person to the board to deal with the day-to-day operations of the corporation, and they'll work in tandem with that individual while settling the estate.
If I can just add, but if you're operating, anybody here on the call, I know from experience, if you're running an operating business, and especially if you're in a contracting business, your banker and your surety bonding company is going to want to know who is your successor. And then they have the right to create a lot of problems, right? Without a line of credit, they pull it, because don't forget, a line of credit is callable by the bank at any time. If they feel the covenant is not protected, they would have the right to change that. So, and I'm sure you've seen that as well. So therefore, that business succession slide that you talked about, the operational slide, doesn't even have to mean anybody in the family running it, but just a good operational succession, management succession, good corporate governance will protect the value of your estate. No, just from experience, no question about that.
Any other questions from home?
Just go to your slide with the unique challenges.
Sorry, thank you.
This one?
Yeah, I would just say that, I mean, having a will and a plan in place, everybody should have that, but I think this is a very powerful slide. And if anybody at home or here has any of these red flags that you see here, there's a lot of advanced planning that can be done as a team with your advisor, somebody like Paula, your accountant, lawyer. They're all items that have solutions, but they often need outside the box and not cookie cutter approaches. So I would leave, this is a great visual. There's a lot that can go wrong if not properly addressed.
So thank you. I would leave this because if we want more sessions, we have to promise to keep it on time.
Sounds good.
Again, I would suggest that anybody who has questions, or if they maybe even a poll, if you think there's more items like, administration number 2, number 3, number 4, we can hijack Paula again and bring her to bear. But again, thank you, everyone. Enjoy your American Thanksgiving.
With your assets across the border.
So thank you very much, Paula. Again, thank you for your time. I appreciate it.
Just a
Yes, thank you.
reminder for the people at home, Kent is staying on for a few minutes if you have any
You
additional
sit us down for
questions.
2 hours. Just kidding.
If you have any additional questions, Kent will be online for a few minutes. If you have anything outside of specifically this topic, that's also fine. You can ask Kent.
Yeah.
And Jordan, one last, we had a
slides.
request for the slides.
we
We'll be
will-
sending the slides
We'll
out.
be
Yeah.
sending, we'll be sending out an information packet to everybody who's online or anybody who's been there. So we have the hard copies here, but we'll also send soft copies because they're useful. But we'll send all that information out. Thank you.
And
Thank you.
Thank you.
Thank you.
Appreciate it. Thanks, guys. I gotta go have turkey now. Just kidding.
Hello, and just wanted to say, just to reiterate what we were saying before, materials, the slides from tonight's presentation, as well as other notes will be sent to all attendees of today's webinar, and we'll be forwarding those in the next day or so. And if anybody had any other questions, that would be great. If not, that's okay as well. Obviously, when you go through this material, and it's going to elicit a lot of conversations, you know, not only with people that are also on this call, but also family members. So when you have those questions and when you have those conversations, I think Richard said this as well, but feel free to reach out to any advisor here at IP Private Wealth, and we'd be happy to have those deeper conversations with you and the family as well, and just to make sure that those questions are answered. It's looking like people really enjoyed this session. I know people don't want to talk about estate planning. It's not a common thing to want to get up in the morning and attack. But obviously, when people have done well in life, they want to make sure that things are taken care of in a purposeful, professional manner. And I think that we'll probably be having other sessions like this just because of the value add and because it has started a lot of really good conversations for clients. So I'm not seeing any other questions in the chat box or anything. If people don't have any other questions, I will just leave it there. Again, you can feel free to reach out to any of us, any of the advisors, any of the people on your team, and we'd be happy to have other conversations with you if you have any other questions that come with your way. So thanks very much. Thanks for attending, and we're going to sign off there. Cheers.